who was here last year? All right, and was anybody here the year before? Aren't there some law school students who do 3 years?
Yeah. But they come into the group in their second year.
Ah, you discriminate against lawyers. I went to the law school on the way here. I accidentally went there because I thought that's where this was. So. Well, since I'm 15 minutes late, I apologize for that. And I'm going to keep my remarks to a minimum so that we can do question and answer, because I think that's always way more interesting than just listening to somebody sit up in front of a room and babble in front of a fireplace. So, I think that the world of startups and tech investing and venture capital is at a really interesting time right now. I think that we are in the midst of a number of important technological changes that are working their way through the system, and I think starting to impact lots of people. Mobile would be one, and obviously mobile's been a big deal for a long time. The iPhone launched 7-ish years ago now, and yet I think that we're still just beginning to understand how impactful having a computer with you all the time is, and not only in good ways, but the other day my wife and I were in a restaurant. My wife and I have been together for 33 years, and we still go out to dinner and put our phones away and have a conversation about whatever it is that we can figure out to talk about. And sitting next to us was a couple having dinner. I don't know if they were married or on a date or whatever, and they were both on their phones like the whole dinner. It was kind of depressing. It made me realize that that you can use technology for lots of good things, but some people obviously use technology to, I guess, avoid having a discussion on a date or something. That's kind of what it appeared to me. So anyway, that's a little bit of a digression. But anyway, I think that we're still in the early days of the amount of innovation that's going to unleash. And I also think that we're seeing some important new areas emerge, and mobile being a facilitator of, but not necessarily the central part of the smart devices sector. Obviously Google's acquisition of Nest would be something you point to as kind of a bellwether event, but I have a drop cam. I have a ski house in Utah. I have a drop cam that I use to just check on how much snow's out there. So, because I don't totally believe the snow reports, so now I actually have, a real camera that can tell me exactly how much snow is out there. And it's amazing, honestly, to be able to take a device and configure it in a matter of seconds to be connected to a smartphone or tablet, and then be able to stay connected to that device when you're, across the country. My friend Jamie Seminoff has a company called Doorbot. My wife's a small investor in Doorbot, and Doorbot is kind of what happens when you marry a drop cam to a doorbell. And he tells a story about literally being in China, meeting with the factory that was going to manufacture these Doorbots, and someone came to his door in Los Angeles, which is where his company is, to deliver some shirts from the cleaner. And his iPhone rang in China, and there was the guy standing at his door in Los Angeles, and he said, "Oh yeah, go around the corner, hit the button in the garage, and just leave the shirts in the garage for me, and close the garage on your way out." Kind of amazing. I mean, we all know that's possible, but just when you hear these stories and you think about it, it's like, wow, that's kind of amazing. I answered his door in China. So I think this whole Internet of Things, smart devices, has impacts in quantified self, and has impacts obviously in smart home, and probably a lot in cars, and probably a lot of other places that we're not even imagining. And then there's things like the innovation that I think is being unleashed with Bitcoin that potentially is creating a distributed global financial system that could potentially over time replace or at least supplement or complement the traditional system that we've had for at least 100 years or more of modern banking and finance. So these are just some of the things that are going on, and every time that I think we're in a period of relative sort of stagnation, something new and big comes along to kind of kick things back in gear. And honestly, it's hard to stay on top of all of this. I feel like there's as much interesting, important things going on right now as there has been at any time that I've been in the venture business, and that's getting close to 30 years now. So, I'm pretty enthusiastic about the opportunities for both entrepreneurs and investors, and also for people to go join companies and become, early members of the team. I think all of those opportunities are probably on the table for all of you, and it's just a matter of kind of figuring out what sector and what kind of work you want to do. But I don't think there's a better place to start, building a career right now than the world of technology and startups. Just given the amount of energy and activity and potential growth and development, and also making money, which I'm sure everybody's at least somewhat interested in. It's kind of a golden era that we're in, and so I certainly feel lucky to be part of it, and I would encourage all of you to try to take part in it as much as you possibly can.
You mentioned a golden era, and I'm just thinking to some extent with the level of hype and activity and excitement and looking at the stock market and technology stocks, you don't have any inklings of a bubble once again, or why it might be different than it was in the late 90s?
Well, I was thinking of the golden era, not in terms of this year or last year, or I was really thinking of it as a golden era that's been going on for 20 or 25 years now. Meaning that, I think the kind of fundamental change that is going on in business and society right now as a result of largely the internet, but also the computer technology revolution, software, all of that kind of coming together, happens about once every, 100 to 200 years. And probably the first 50 years of that era is when the most profound change happens. And so that's what I meant really by golden era. Look, it's very hard to make sense of a lot of the stock prices that are out there. It's not hard to make sense of the stock prices of companies like Google and Apple, but it is quite hard to make sense of the stock prices of companies like Facebook and Twitter, a $19 billion acquisition of WhatsApp, and you try to make, we're sitting in a business school classroom, so it's really hard to take the kinds of structures that they teach you in business school and make sense of any of this stuff. When companies trade at 10 times revenues, when I was in business school, companies traded at 10 times earnings. So unless your earnings are your revenue, those two don't foot. And so I do think part of it is because the interest rate environment has been so low for really since the global financial crisis in 2008, that there's just a lot of capital out there in the market, chasing yield and chasing return and frankly chasing growth. And I think for whatever reason, companies that have a lot of growth are getting these incredible premiums to traditional companies. And it may be the market is saying that these technology companies are going to, as a cohort, really undermine lots of the current sort of mainstream businesses, and therefore the current mainstream businesses will trade at 10 times earnings, and the technology companies will trade at 10 times revenues. Maybe that's what the market is saying, but I think it's also a little bit to do with the overall monetary environment and low interest rates. And I think if we return to a more normal interest rate environment of 4, 5, 6, 7% interest rates as what you could earn on a corporate bond or a 30-year treasury, it would be hard to see how some of these valuations could sustain themselves in that environment. So I'm not really a stock market investor. I don't actually own any stocks other than the stocks of companies that have come out of our portfolios. I don't own any bonds either, so I'm probably not a good person to listen to on that, but maybe the mere fact that I don't own either stocks or bonds is also enlightening at some level. But that's my point of view on it.
What was some of the technology like, or the projects like, when you first started in venture capital versus today? What were you looking at?
It was the era of PCs and PC software. So I got into the venture capital business in 1986. The Apple Macintosh came out in 81 or 82 or 83. I'm having a hard time remembering exactly when. The IBM PC came out around the same time. And that was the brand new platform of the moment. And then there was a whole bunch of software companies that got started, and there was also peripheral companies, so printers and disk drive companies and all that kind of stuff was what we were investing in back then. And so when I got in the business in '86, the hardware piece of that era was starting to mature. So it was harder to make money in hardware. It was still quite possible to make money in software. And then slowly but surely, Microsoft really kind of sucked a lot of the life out of the entrepreneurial sector in software, in PC software. They ended up really winning the operating system race against Apple, and then started to use their operating system dominance to sort of soak up all the application software layer as well. And then what happened is that networking came about. So you had companies like Novell came along for the local area network, and then companies like Cisco came along for the wide area network, and then you started to have client-server computing, where it was more sort of enterprise applications, where people started building large enterprise applications that ran clients on PCs and servers for workgroup computing. And then the internet came along. That's kind of been my career in a nutshell. All the way in the back.
Yeah. So you mentioned Bitcoin. Obviously, you guys are involved with Coinbase, and
Right.
with Mt. Gox crashing, going into bankruptcy, I'm just curious to hear your thoughts on that, what that means for Coinbase and for other folks.
I don't actually know exactly what's going on with Mt. Gox, but clearly there's something that's not right with that company, and maybe something came out today. I was kind of busy all day, so I don't know exactly, but there's definitely something kind of pretty bad going on there. And I think one of the things that is unfortunate about the current Bitcoin landscape is there aren't that many exchanges of real scale that have become big pools of liquidity for Bitcoin to normal currency transactions, regular currency, whatever. And Mt. Gox was the first, and for a long time was the biggest. They have got overtaken by a couple of the other exchanges in the past 6 months. And they haven't been the biggest for a while. But even so, there aren't that many of them, and I think that that's a real negative for Bitcoin in general. I think if you had a couple dozen pools of liquidity around the world, there are none in the U.S., which is another big problem. If you had 2 or 3 in the U.S. and 2 or 3 in Western Europe and 2 or 3 in Asia and a couple more in other parts of the world, I'd feel a lot better to me. There are a bunch of reasons why there aren't any in the U.S., and they're mostly related to sort of the twin problems of the banking system and regulators. So to operate a Bitcoin exchange in the United States, you'd need to be regulated as a money transfer agent, and you'd need to have licenses in all 50 states to operate. So that's a problem. And you'd need to have at least one relatively major U.S. bank providing a connection between you and the U.S. banking system. And it's very difficult to get either of those two things done. And this is an example of a case where you have a global platform, network, whatever you want, technology platform, and so anybody can set up shop on it anywhere in the world, just like the internet. But because the regulatory environment in the U.S. is more difficult, most of the innovation, or a lot of the innovation, is happening outside the United States, and all the biggest exchanges are operating outside the United States. So, you know, I think what we will see happen over the next 6 to 12 months is some U.S.-based exchanges get launched, and I think we'll probably see a bunch of new exchanges crop up. At least that's what I hope will happen. But it's really quite necessary. And I think the other problem with Mt. Gox is that operating an exchange is at the kind of scale that we're now operating. I mean, when Bitcoin is at $500 or $600, or where it was earlier, or late last year at $1,200, that's a lot of real money that's sloshing around all of a sudden. And you know, when Mt. Gox got going, I mean, it was, you know, it might have been, you know, kind of a relatively janky piece of technology that they were operating on, but it was the only game in town. There wasn't a whole lot of stakes, financial stakes, so, you know, that's what it was. And as the stakes have gone higher and the level of technology that you need to operate in, you know, with the scale of the system that is, you know, in place now, and also the dollar value of money that's out there, I think you got to have a much better and more solid technology and infrastructure and set of, you know, policies and procedures than they had. And so in some sense, I kind of think of it as an example of, in a lot of sort of ways of innovation, the very really early people, you know, who first started, you know, kind of fiddling around with something, weren't ultimately the ones who ended up winning, because they didn't. Search, you know, probably is a really good example of that, where the first innovators in search, web search, probably going back to the mid-90s, you look at their technology versus, you know, what Google ultimately launched in the late 90s, and, you know, Google just was 10x or 100x better. And I think that some of the Bitcoin exchanges that I'm hearing about now getting launched are being launched by people who've operated the New York Stock Exchange, you know, that really understand, you know, how to operate, you know, a system like that and have it, you know, be secure and auditable and have compliance and all that kind of stuff built in. So that's kind of how I think about it. So in some sense it may have been inevitable that, some of the early leaders are going to get, kind of squashed along the way. The worst thing about it is a lot of people lost a lot of money, and that's probably the most unfortunate piece of the whole story.
In the short term, with Title III kicking in of the Jobs Act, how do you see the VC model changing, and over the longer term, how do you see it evolving?
Well, so I'm a little disappointed in the way that the SEC actually implemented the Jobs Act. I mean, if you go and read the Jobs Act and you interpret what Congress wanted to see happen, and then you go look at the actual implementation that the SEC has put in market, it's a little disappointing that they've still sort of maintained this notion that if you want to buy stock in a private company, you really need to be a wealthy person. Like, there's so many requirements on the entrepreneur if you want to raise money from non-accredited investors that most entrepreneurs would not, particularly most entrepreneurs who have a lawyer advising them would not choose to do that. It's just that there's all kinds of restrictions and potential liabilities that you take on if you do that. So I actually don't see very many financings, if any. I haven't seen really any financings happen with non-accredited investors. So the most transformative parts of the Jobs Act, the idea that an entrepreneur could raise equity capital for their company the way that an artist raises money on Kickstarter, in 5s and 10s and 20s and 50s, that's not really happening. And so I didn't answer your question necessarily, but my point is that I think that there could be a lot more done to make it easier for entrepreneurs to raise capital and make it easier for the average person to invest in startups than we actually got done with the Jobs Act. So I'm sort of disappointed. Now, as it relates to the venture business, most venture capital money goes into companies as they're scaling. Most of the real early money that entrepreneurs raise in the first 6, 12, 18 months of their company come from angel investors, friends and family, their own pockets, working for free, burning off your savings, those kinds of things. And it's really when the company kind of hits an inflection point and really starts seeing customers adopting their product or users adopting their product, and it's usually after that a lot of the venture capital comes in. And those companies need, at that point, they need $5 million, $10 million, $15 million of capital. And I don't think that, sort of the crowdfunding model, yet anyway, is necessarily going to scale all the way into where the majority of the venture dollars are deployed into the market. So I actually don't think that in the near term, crowdfunding, Jobs Act, whatever you want to call it, is going to really impact the venture capital industry very much. And I think it actually, if anything, could benefit it because there'd be ideally more entrepreneurs get that initial 6, 12, 18 months of capital to see if they can get to that inflection point, and then therefore ideally more entrepreneurs get to that inflection point and there's more opportunities for the venture capital industry to invest in. I think if you go out 10 or 15 or 20 years, I think all bets are off because that's, well, first of all, it's a long time from now, and second of all, maybe we will have more changes made to the rules around investing, and we could have a different scenario play out. My partner Albert thinks that eventually we're going to see a complete blurring between the public and private markets. Today, There's a very, crisp delineation. You're a private company until you file to go public, and then you're a public company. But imagine, if we really had the Jobs Act implemented the way Congress actually wanted it, and you could literally sell equity to anybody on a website like Kickstarter in 5s and 10s, and then if there was a secondary market that emerged, for those private companies where people could then go back to the market and sell their positions, you essentially would have effectively the same thing that exists in the public markets. And maybe the only difference is the amount of disclosure that a company needs to make when they're a year or two old is different than the amount of disclosure they need to make when they're 3 or 4 years old, which is different than the amount of disclosure they need to make when they're 5 or 10 years old. Maybe by market cap, when the stakes get higher, maybe the disclosure goes up. And if Albert's right, that'd be an amazing thing. But maybe that's where we'll get to in 10 or 15 years. But I think right now, combination of the Jobs Act has largely been a disappointment, and the reality of where most venture dollars go, I don't think it's going to have much impact on the venture business in the short term.
So you've sort of watched the emergence of the New York ecosystem. What role do you think that investors play in seeding ecosystems outside of the Valley or New York?
I think investors have an important role to play. It can't happen. Investors alone can't make it happen because the raw material of a startup ecosystem is the entrepreneur, not the investor, right? So if you don't have entrepreneurs, you're not going to have startups, and you're not going to have a startup ecosystem. But investors can play an important role. I think that being cheerleaders is important because it's a little easier in some ways for somebody who has a portfolio of 15 or 20 or 30 companies to be an advocate for the community at large versus an entrepreneur. And also an entrepreneur's got to focus on running their company and can't do a lot of that community building stuff, or it's not as easy for the entrepreneur to do the community building stuff. Also, investors who have the right attitude. One of the problems, for example, in certain parts of Europe and other parts of the world where the capital markets for startups are not as developed is that the terms that the capital comes with are very unfriendly to entrepreneurs. Investors are negotiating for 20, 30, 40, 50% of a company for $500,000 or $1 million. That's not going to really go a long way in terms of building a community of entrepreneurs because it's just not going to be enough. It's not going to be interesting to an entrepreneur to dilute that much day one. And also investors who know how to work with entrepreneurs and help them be successful. So I think having good experienced capital that takes the right approach to building companies and is also focused on community building, cheerleading, and kind of getting people excited about a community, I think could be very impactful. Yep.
So you talked a little bit about decentralization recently. I wonder if that, as an investment theme, you think that's sort of like a cyclical theme, like 5-10 years it's going to be about consolidation again, or is that sort of like an evergreen thing that you have thought about for the last 30 years?
So I guess the way I think about it is that as a market matures, it tends to consolidate, but that the most interesting innovative opportunities for entrepreneurs are when a market is highly distributed and there's not a whole lot of structure yet established in that market, so it's easy to go and grab a piece of it and try to build it and own it. And so what we like to look for is emerging new markets that are highly distributed and have a lot of don't have a lot of structure, and there's a fair amount of chaos around them, and that's where we like to try to make our bets. And as markets consolidate, we tend to back away from that.
There's a lot of software and connected devices showing up to kind of deal with a lot of the operational inefficiencies in healthcare. And I'm wondering if you think that's like kind of a big space going forward in the next couple of years.
So I think healthcare is a very big opportunity. I feel like there's a bunch of things happening in healthcare all at the same time that have the potential to come together in some important ways. We are not that excited about technologies that are being sold into the existing healthcare system, whether it's particularly at sort of the into the really large healthcare organizations, hospitals and that kind of stuff. Doctors' offices are more interesting, and patients, or just everyday people, to us are the most interesting. And some of the things that I think are happening right now are an important change going on in the underlying sort of structure of the healthcare market, which I think is moving slowly but surely away from employer pays to patient pays, except for catastrophic, and an opening up of the data. So a lot of emerging standards now around data in exchange. Some things in Obamacare around really incenting the creation of EMRs at the patient and doctor level, which then combined with open data standards, I think can have a lot of impact. And I think just patients generally, getting more excited about taking control of their own health care and feeling for the first time in a long time that they actually can be more in control of their own health care and their own data. And so these, I think, are all big trends. And so I'm quite excited about the opportunities that those trends will unleash. But I'm not that excited about selling, high-cost capital equipment into the healthcare industry, even though that's a good business that people have been in for a long time. It's just not something that we're that excited about.
Yeah, I'm just curious if you could talk about what you think your competitive advantages are, or what differentiates the good VCs from the bad VCs in terms of either process or philosophy.
Well, the venture business is a big market, and there are a lot of different ways to be in the venture capital business. So, I don't think there's one way to be good at the business. I think some of the differences are early stage versus later stage. That's an obvious one. I think in those two dimensions, I think what makes people successful at an early stage is very different than what makes people successful at a later stage. So the firms that are really good at making later stage investments are all about access and being able to win a deal in a competitive environment. So if you want to be a great late stage investor, you got to be on the short list when people are going out to do a late stage financing, and then you have to be able to convince the entrepreneur, take money from you versus 3 or 4 other good choices. And you can win because you're always willing to pay the highest price, or you can win because of some brand advantage or some expertise in a particular market or something like that. But that's a very different business, because the very best investment opportunities at a later stage are going to be highly competitive, and everyone's going to pretty much already know that's going to be a winning opportunity, and so it's a real challenge to win those deals. On the early stage, particularly seed and early Series A, and even sort of traditional Series A, I think a lot about that business is about getting to the opportunity before other people get to it. Recognizing that a sector is an important emerging sector before other people recognize that, and becoming one of the top 2 or 3 investors in that sector by virtue of the investments you've made and by virtue of the fact that you have been in the market, like talking to entrepreneurs and developing an expertise in that sector. That's the game we try to play. And then we add on top of that a commitment to trying to be the best investors that we can be for the companies that we've invested in. And that's a lot about making the companies we invest in a priority, keeping the number of investments we make to a small enough size that we can really spend quality time on those companies. And it's about referencing well with entrepreneurs and having the companies that we've invested in the past tell entrepreneurs, yeah, they were the best, or they were one of the best investors I had, and they're great to work with, and they can help you in 10 different ways. So that's how we try to win, is a combination of getting there before anybody else does, and then having a great reputation by actually doing the hard work of helping the entrepreneur when it matters. And that, as I said, really comes down to the amount of time and energy that you can actually apply. So that's how we compete.
I have a question about, what do you think, here in New York City, kind of the scene here, what do you think some of the best resources are for vetting and really early product testing here in the city, ecosystem-wise?
Are you talking about like getting your product in the hands of users?
No, probably even before that, like idea vetting and talking to people, trying to get concept and maybe as an extension of that a little bit into the hand of users, like really early alpha testing.
Right. I think other entrepreneurs are great for that. I mean, a lot of people come to see me for that kind of thing, and I actually think I'm pretty bad at it. It's hard for me to evaluate an idea when it's on a whiteboard or on a napkin or on a pitch deck. I mean, I can do some of that, but I think other people who do that for a living, who sort of do the ideation and birth products, have their brain wired up to be able to think in that conceptual stage really well. So I actually think other entrepreneurs who are who have been successful or are launching products, getting to know them and networking with them, particularly if you're doing something on mobile, somebody who's launched some mobile apps already, like those would be the resources I would be trying to network into and connect to.
For those of us looking at venture capital as a long-term career, what are some of the important things to remember when we're thinking about where we should go, say immediately out of school, or the kind of opportunities that we should be pursuing? What kind of firms should we be looking at? What should we be thinking about?
So I think the venture business, it's a tough business to be good at quickly. There's just a lot of things that you've got to learn, and if you, like me, decide that you want to go into it early on in your life, I got into the venture business when I was 25 years old, then I think you are setting yourself up for as much of as a decade of kind of coming up that learning curve. And I actually think that I spent a decade figuring out how to be a decent venture capitalist. And then I spent another decade figuring out how to be a really good venture capitalist. And it really wasn't until my partner Brad and I started USV in 2004, was 18 years into the business by then, that I feel like I really was quite good at what I was doing. And so I think it doesn't have to take that long. My partner Albert, for example, spent 15 years doing startups and either starting them himself or being on the founding team or coming in to run startups. And so when he got into the venture capital business, I think he had a phase of maybe 5 to 7 years of going from being a novice at it to being really good at it. So what I generally recommend to people is to take the path that Albert took. Take 10 or 15 years between 25 and 40 and go work in 3 or 4 startups, and maybe pick a certain kind of sector that you want to really be great at, and then go into the venture capital business when you have that expertise. I'm not saying that the path I took is a bad path. I just think that it's a much longer roadmap. You don't have the network, you don't have the Rolodex, you don't have any domain expertise, you don't really have any credibility with entrepreneurs. So they're not going to choose you over somebody else. And it's kind of a frustrating place to be while you're doing that. I don't know actually why I put up with it for so long, but I guess
Yeah, so it's not exactly related to like an investment thesis or specific portfolio company, but I think the Fireside setting here feel warranty to get on topic. You mentioned this golden era coming around for 50 years, once every 200 years. I'm curious, are there any precedents you study, maybe sitting next to a fireplace that you read about, to sort of give you context and sort of intellectual sort of understanding of what's going on now?
Yeah, well, there's a great book that I always recommend to people, written by an economist, Venezuelan economist of all things. My partner Brad likes to call that an oxymoron, but anyway, named Carlota Perez. She spells her name Carlota, and it's called Technological Revolutions in Financial Capital. And it's a pretty academic book, which means to say that it's dense and not particularly entertaining to read. But what she does is she goes back goes back to the Industrial Revolution and looks at the Industrial Revolution. She looks at the automotive era, and then she looks at the computer era, and she looks at sort of the time period over which that technological innovation came into market and then ultimately impacted society. And it's a fascinating read, and there's just some great insights. My partner Brad and I read it while we were raising the first fund for USV, and we started really talking a lot about her book when we were raising money, and we kind of used it as a lens through which to look at that time. And it was a great lens to look at 2003 and 2004. But basically, just give you a couple of insights from her book. So, the automotive revolution, right? So, the first cars were, originally, invented in the late 19th century, and then there was the invention of the manufacturing line by Henry Ford, and we had mass-produced automobiles, and that really produced a lot of the speculation that happened in the Roaring '20s, followed by the financial crash of the late '20s, the Great Depression. It wasn't until the '50s that we saw a lot of the societal impact of the automobile revolution, and the societal impact would be things like the suburbs, like shopping malls and fast food restaurants and things like that that were byproducts of the invention of the automobile and the mass deployment of the automobile in society, where 80-90% of society had a car. And that's what when we think about what happens when 80 to 90% of society has a smartphone, and what are the fast food? What is the fast food industry of the smartphone era? What is the suburban migration of society out from the inner cities into 50, 60-mile radiuses? And so anyway, so the answer to that is yeah. I think about it all the time.
There seems to be a rapidly evolving understanding of privacy in the general public, in the government sector, and amongst the large technology companies. How do you think about privacy?
Well, so I think privacy is a really, really important issue. The biggest issue I think that we really have to get a handle on right now around privacy is the fact that we've moved most of our lives onto the internet, and that in doing that we have made it way easier for all sorts of people and organizations and governments to essentially collect that data and do things with that data. And I've heard people say that data leakage is the pollution of the information era, right? So when the industrial era emerged 150 years ago or 200 years ago, people were polluting. They built a factory and they started polluting, but nobody really worried about it very much. And it wasn't really until, maybe 100 years into the Industrial Revolution that we started having an environmental movement, and people started to say, that's terrible. There's no fish in the Hudson River, I don't mean to go on a tangent, but somebody told me at one time that the greatest resource of oysters in the world is New York Harbor. There were literally like trillions of oysters in New York Harbor. And today there's no oysters in New York Harbor, right? Because we polluted the harbor to the point where the oysters couldn't live there. And so we figured that out, and now we have an environmental movement, and our rivers are cleaner, and if you have a factory, there's certain requirements for how you have to operate, but it took a long time to get there. And if data leakage is the pollution of the information era, I think we're getting to the realization of the magnitude of that problem a lot more quickly, 20 years or 30 years into it. But it is a profound issue. And the thing about it is that still to this day, I think most people don't really give a shit about it. Most people know that the government is snooping on us, and most people know that Google is snooping on us, and most people know that Facebook is snooping on us, and most people know that there may be bad people actually who have access to our private communications and doing identity theft and other nasty stuff with it. But the reaction to it in terms of the uptake of technology that would actually protect you from that is pathetic. It's like really pathetic. Like very few people care enough to do really anything about it. So that's one problem. The other problem is that the kinds of technologies that exist to actually do something about it, mostly crypto and all that kind of stuff, actually in some ways are really bad because we've gained a lot from the very same things that have made it possible for all these people to snoop on us, have also made it possible for a lot of the innovation that might happen in healthcare or might happen in finance or might happen in other places where we can get to sort of collective intelligence, where we're actually sharing a lot of data with each other and with companies that might be able to use that data to help us. And so if we all just essentially encrypt all of our communication and start using Tor and becoming, anonymous out on the internet, that feels like the wrong place to go too. So I think this is a really, really important issue. I don't have a roadmap in my mind of how we get to a better place, but I think that if you were looking for a sector to get out ahead of most people, I think this would be a sector that should be quite fruitful. I think to be trying to innovate in, because I think it's an enormous problem. We got to get some answers.
You've always in the past shared a war story or something that you're reminded of today from Euclid. I'm wondering, as you wind down Flatiron finally, if there's some stories you wanted to share that remind you of either the bubble days or transitions or.
Well, for me, the post-internet crash years of 2000 to 2003 were really the most important years for my career. I really learned a tremendous amount from that experience that has really helped me be a better investor and has helped me have a strong set of values and opinions as it relates to making investments, and a lot of them come from a lot of painful lessons that I learned. But I'll tell you a story because you asked me to. And that is that we started Flatiron Partners in 1996, and we really didn't have any idea what a good thesis was for internet investing, other than if it's an internet company investing in it. Like, literally, that was our investment thesis. And the thing about it is that it was actually a brilliant investment thesis, because just in terms of dollars and cents, we had a $150 million fund that we raised in 1996, and by late '99, we had made we had basically distributed over $750 million back to our investors on that $150 million. And these weren't great investments. I mean, when you look at these companies now, holy moly, I mean, made that much money on that piece of crap. But that was what, if it was an internet company, it got bid up to incredible heights during the bubble. And then we raised another $350 million fund in 1999, and returned probably another $250 to $350 million on that fund before everything blew up. And so we had done very well. We had our sole financial partner in that business was Chase Bank, and then they merged with JP Morgan right around that time, early 2000. Then the crash came, and within 6 months, the combination of a new owner of our sole financial partner, combined with a portfolio that was literally crumbling now. Like, so we had made a lot of money, but what was left was just in shambles. And the folks that we dealt with at the bank basically called us in and said, this isn't going so well. We need to wind this thing up, which was pretty bad. I mean, basically they said, we're shutting down. And so that was tough. But anyway, so we had made about 55 investments total. In that $500 million, we made about 55 investments total. And we had exited about 20 of them. So we had about 35, 36 companies left. And so the 20 that we had exited had produced basically like $1 billion. So it provided great returns on the first 150, and it gotten most of the money back on the 350, but it was just like everything else just looked terrible. And so we did a triage, and we basically, so I led the negotiation. I had two partners at Flatiron. I led the negotiation with the bank, and I convinced them they didn't want to put any more money into this. They were done. And I said, you got to give us another $50 million to work out this portfolio. And they said, okay, we'll do that, but we're going to have to approve every one of those investments that we make out of the 50. So like they really shut us down. Like you guys screwed up, and you're not going to get to invest the money without our approval. So even though we had made them a lot of money, so we had to do a triage because that $50 million was not going to support all 36 companies. So we basically decided that we didn't have a formula, but as we went through it, it kind of emerged that about a third of them we just had to shut down. Like they were just no way that these companies were going to be able to, like they weren't companies. It was complete garbage. And then there was another roughly third that if we put $1 million or $500,000 or $1.5 million in, we could kind of restructure it and get it to a point where maybe we could merge it with one of its competitors, and then that company could potentially make it as a standalone company. But there was no path to get those companies to being a standalone profitable business on their own. So it was, let's, figure out how to fix it and get it sold, but we can't really go long on this one. And then there was about a dozen companies that we really felt were on their way to becoming real companies. And so of that $50 million, we probably invested, 5, maybe 10, but probably closer to 5 into that middle third. And we got those companies sold, and we didn't get much for that. We got more than the 5, maybe we got 10, maybe we got 20, maybe we got 30, I don't really remember. But that final 12 that we kind of decided to really, go with, we put the majority of the money in, and it was tough to get those companies financed. Like and our money wasn't enough to get it done, so we had to get other people involved, and it was really hard. This is the big lesson I learned during that period. But out of that final 12 came some huge wins, some humongous wins. Companies like Mercado Libre, which is the eBay of Latin America, and it's worth I think $5 or $6 billion now. I mean, it's a very valuable company. It's a real business, man. It's a monster business, and we own 25% of that company. I mean, we sold a lot of our position at the IPO, so we haven't ridden it all the way to where it is now. But that final $50 million, which was largely allocated to those 12 companies, probably produced a 10x on that $50 million when it's all said and done. And so I tell you that whole story. The formative lesson that I learned from that is that when things turn to shit, you really should not fold your hand. Like, and there was a ton of people who literally folded their hand. And honestly, I think if J.P. Morgan Chase had their way, we would have just folded our hand. But I didn't want to fold my hand for a couple of reasons. One was I didn't want to give up. And two, I also felt an obligation to the entrepreneurs and our co-investors. And so I felt like we had a responsibility to be, to do the right thing. And so I didn't want to give up. That's why we negotiated for that extra $50 million. But the big lesson is that I took away from that is that when everything looks bleak and just horrible, there probably is something that you can hang on to. But what you have to do is you have to triage, and you have to get rid of a lot of stuff. So I saw actually some of our companies do this during this time, where they went from 100 employees to 10, right? Like they literally fired 90% of the company, hunkered down, husband their cash, and then started building again. And so then you can get just enormous financial returns by doing that if you make the right bets. And so I don't believe in in quitting and folding and giving up when things are really bad. I believe in doubling down, but doubling down like rationally, not emotionally, but rationally, and making the hard decisions and figuring out, what you can actually, what actually makes sense versus all the stuff that you were doing didn't make any sense, and trying to clean that up and do that. So that's a big formative lesson for me in my life, and I make a lot of decisions based on those experiences even to this day, and it gives me a lot of confidence to do that.